Hi everybody, it's Sohana and you're at the front of finance. This is the course Investing 101, Part 5, Investing in Stocks. So let's get started. Through today's session, we will explore how to evaluate and select the right stocks for yourself. Selecting the correct stock is crucial. It essentially determines whether you gain a profit or go into a loss, which is the fundamental essence of investing. And the answer behind choosing the right investment lies in research. And that doesn't mean relying on Google and searching up what stock to buy today, but instead conducting research on the company whose stock you're planning on buying. Now, this research can be of various types, and one very popular type of research, or rather an analysis, is the technical versus fundamental analysis. Technical and fundamental analysis are two different approaches used by investors to analyze stocks and make investment decisions. They can be divided into fundamental analysis and technical analysis. Fundamental analysis examines the intrinsic value of a company. It analyzes things such as the company's financial statements, the management team, competitive position, industry trends. This is primarily used by long-term investors who aim to hold stocks for extended periods of time. So you're essentially understanding and evaluating the performance of the company whose stock you're planning on buying. Technical analysis, on the other hand, examines historical prices, trends, and volume. It analyzes patterns, past and future trends through line graphs, pie charts, and volume trends. So clearly, technical analysis relies on past trends and past data to make predictions about the future of stocks. Technical analysis is primarily used by short-term traders who aim to profit from short-term price fluctuations. Furthermore, a very important factor to consider is the company's financial performance, and there are several means to evaluate this. First and foremost, we look at the income statement of a specific company. An income statement is basically just a financial statement that shows you the company's income, expenditures, as well as whether a company is making a profit or loss for a given period. So the income statement basically allows you to evaluate the company's financial health and performance, and ideally you should be able to subtract the company's expenses from its revenue in order to understand whether they're making a profit or a loss. As an investor, you will want to buy a stock from a company whose income statement indicates a profit. Next, we have the cash flow statement. A cash flow statement summarizes the amount of cash and cash equivalents entering and leaving a company. It indicates the revenue gain and expenditure in terms of cash. Now, what exactly do I mean by cash and cash equivalents is something that I've broken down here. Firstly, we have operating activities, which is basically the cash received from customers as well as the cash paid to employees for operations. Next, we have investing activities, which is basically the cash used for purchasing long-term assets as well as from the sale of these long-term assets that are existing within the company. Then we also have financial activities, which is basically the cash received from borrowing debt, issuing stocks, and cash paid as dividends. The product of all of this is the net cash flow, which is basically the overall change in cash during the reporting period, or the specific period of time that the investor is studying. The next indicator of the company's performance that we'll be looking at is the balance sheet. A balance sheet includes information about a company's assets as well as its liabilities and the shareholders' equity. So now the shareholders' equity is basically the stocks owned by shareholders of the company, and this can be divided into the common stock, which is the value of the shares issued to the shareholders, as well as the retained earnings, which are the accumulated profits or losses as a result of these shares. An ideal balance sheet should satisfy the equation that the total assets that the company possesses is equal to its liabilities as well as the shareholders' equity. Furthermore, a company's financial performance is not the only factor that we have to take into consideration. There's also the company's valuation, which is very important to analyze. The first tool that we're discussing, which really analyzes a company's valuation, is the earning per share, also known as the EPS. So the EPS is basically the amount of money a company makes for each, also known as the revenue per share. The purpose of EPS is that it indicates the profitability of a company. In order to further understand how an EPS indicates the valuation of the company, is that a higher EPS ideally suggests that a company is more valuable. And if investors are comfortable paying a higher price for shares, then that reflects strong profits or expectations of high profits from the share. The formula of EPS is net profit upon number of shares. Next, we have the PE ratio, or rather the price to earnings ratio. The PE ratio compares the price of a company's stock to its EPS, or its earnings per share. And it basically helps investors understand the relative value of a company's stock. So in order to further understand what the PE ratio is, we've taken a very simple example. Let's say a company's stock price is $20 and its earnings per share is $2. To calculate the PE ratio, we would divide the stock price, which in this case is $20, by the earnings per share, which in this case we're taking as $2. In this case, the PE would obviously be 10. So what does this mean? Well, a high PE ratio indicates that the share is overvalued, which means that the price is likely to fall. An overvalued share can be compared to a share whose price is so high that it's basically a bubble that's very soon going to burst. On the other hand, a low price to earnings ratio indicates that the share is undervalued, and so the price is likely to rise. As investors, we should consider purchasing undervalued stocks because this indicates that the price of the stock is much lower than the intrinsic value of the stock, and therefore the price will increase or is likely to increase, as a result of which we will earn some sort of a profit. But how exactly would you know whether the price to earnings ratio of a company's stock is high or low? Well, you have to take a point of reference, which means you have to compare the PE ratio of that company with other companies in the industry that are currently doing well. A quick formula for the PE ratio is share price upon earnings per share. The next method to evaluate the valuation of a company is taking into account its dividend yield. The dividend yield indicates the annual dividend payout of a company relative to its stock price. It's calculated by dividing the annual dividend per share by the stock price. If you look at the bottom of the page, we can see the formula is annual dividend per share upon stock price into 100, and so our final value is going to be a percentage. The purpose of a dividend yield is to indicate the ROI, or rather the return on investment, in the form of dividends that an investor may receive from a stock. In case you guys are still confused about what dividends are, I would highly recommend you to go back to our previous video, the types of investments, where we talk about dividends. Now, in order to understand how the dividend yield works, we've taken an example. Let's say a company pays an annual dividend of $2 per share and the stock price is $40. We divide the annual dividend per share, which in this case is $2, by the stock price, which is $40, and multiply the result by 100 to get a percentage. When we put this into the calculator, we get the dividend yield as 5%. And so a higher dividend yield basically indicates a higher return on investment, which means that this is a stock that you should consider buying. And then of course, here's the formula that we discussed in G. There are of course a few other factors to consider when evaluating a company, which I've talked about very briefly. Firstly, the company must have a competitive advantage over other companies. So you want to ask yourself what makes its products or its services different from other companies. The company must also be inclined towards certain industry trends, which we spoke about in the previous module. Next, the goods and services offered by the company must be high in demand or have potential for future growth. An example of this is EVs. EVs do have great and significant potential for future growth, and so recently companies that are producing or manufacturing electric vehicles have been doing significantly well in the stock market. Of course, along with that, there's the company's leadership and management teams required to execute the company's strategy. And lastly, we have the company's dividend history. Does the company return the value to shareholders through dividends, and does it do so within time? Alright, now we've picked up a very simple, relevant, and quite an interesting example example to show you guys how you can evaluate a company to assess whether its stock is worth purchasing. So the company that we've picked up is Adani Green Energy, which, like I said, is quite relevant at the current moment. And let's have a look at the different factors that indicate that Adani Green Energy may show promising results in the stock market. So firstly, we have the large portfolio of Adani Green Energy. It's one of the largest renewable energy companies in India with a great number of operational assets that showcase a significant scale advantage over its competitors. So again, tracing back to our initial point about the importance of having a competitive advantage, because Adani Green Energy's large number of assets, operational assets and resources act as a competitive advantage for them. Then, of course, is the fact that Adani Green Energy is a part of a growing industry. As we all know, the green energy industry is high in demand and has ample government support and opportunities to grow, which is again another advantage and positive indicator of this company's prospective performance. Our next factor is demand, because solar, wind, and hybrid power are high in demand, all of which Adani Green Energy specializes in. And then, of course, we have the management team, because Adani Green is led by an experienced management team with a proven track record in renewable energy. And of course, the fact that the company is owned by the Adani family, which is a renowned multinational corporation. And lastly, we have the company's dividend history. In this case, Adani does have a fluctuating dividend history, which is a negative indicator of the fact that this stock may not be completely profitable. Alright, so now that we've looked at the different ways in which we can evaluate a company's performance as well as its valuation, it's time to have a look at the different investment strategies that we can apply while investing. The first investing strategy is growth investing, where basically you as an investor want to look for companies that have the potential to grow quickly in the future. You have to choose companies that are innovative and offer goods or services that are modern and likely to be in high demand. This traces back to the point of purchasing stocks in companies in growing industries or companies that produce products that are high in demand. Next, we have value investing, and you want to use this strategy to look for companies that you believe are undervalued. Like I explained earlier, a stock is said to be undervalued when its price is lower than its intrinsic value or what its ideal price should be. So as a value investor, you try to find cheaper stocks that are indeed undervalued and invest in those with the expectation for them to rise in value. Value investing usually does result in higher profits because you will be purchasing your shares at a very low price. Lastly, we have income investing. Investors look for investments that provide a regular income. So you might choose to invest in things like bonds or dividend-paying stocks, which again we've spoken about in our second video called the types of investments. So instead of relying on the value of the investment to grow, they want to earn money from it regularly. So they go for safer options such as bonds or dividend-paying stocks. And while these kind of investments may not result in the highest profits, they are a safe and secure investment with lower risks. And lastly, we're going to be looking at the concept of diversification. Again, if you have looked into stocks or investing in the past, you are likely to have heard of this term before, but what exactly is it? Diversification is when you distribute your money across different investments or assets, including shares, bonds, and mutual funds. Diversification helps protect against the impact of a single investment or market event. It also increases the potential for more stable returns over time, thus mitigating risk. Even when investing only in stocks, you must distribute your money across stocks in different sectors or regions. Because like we discussed earlier, industry plays a huge role. So when a certain industry or a certain sector isn't doing too well, then the companies within that sector will not be doing very well either in terms of their performance. as a result of which their stock price is likely to decline. And so it's very important to diversify your stocks in different sectors and industries. And that brings us to the end of today's module. Thank you so much for tuning in, and I really hope that you learned a lot about investing in stocks. Make sure you come back for our next module, or lesson 6, which talks about the practical investment process, giving you insights and tips into how you can start investing as a beginner.